This is CA Akshatha Udupa. I welcome you all to my session on basics of options. I will assume that most of you who are watching this video are new to options and do not have any basic knowledge, very good knowledge. So keeping this in mind, I will go deep into the basics and I will just go through those points or those terms which are important for you as a trader to do option trading. If I go deep into each and everything, then there are many things in options and we will need to do different series for that. But this particular session is basically focused on those terms and those information which is required for a trader to do the option trading. That is a person who is not from the financial background, the person who doesn't know anything about options. These people will be benefited by this video. So keeping this in mind, let's quickly start, and I'll make this session, I will try to make this session as simple as possible so that you will easily understand and relate it to a method you are following now. So yeah, first let's start with derivatives, because before you understand options, it is important for you to know what are derivatives, because without knowing the base directly, if I start with options, you will not understand anything. So knowing derivatives is very important because option is a type of derivative. Okay, so if you want to understand options, you have to know what is derivatives and how did this term options come. So first, derivatives are the financial instruments whose value is derived from the underlying assets. Did you understand anything? I know definitely not. Okay. To make it very simple, let's practically take one example and try to connect it. Okay. The best example that I can give is about the payback card. Whenever you go to a mall or say Big Bazaar or anywhere, they will give you one payback card, right? Why is it given to you actually? Whenever you do the shopping, whatever you purchase, some points will be added to your payback card, right? So once the points increase in that payback card, you will be able to purchase something worth the value in that payback card. So how much value you collect, that much worth of a product you can buy in excess to the normal buying which you do by paying the cash. What is exactly happening is, the moment you do more and more of shopping, your payback points will increase, right? Similarly, the moment the value of the asset increases, the value of this derivative will also increase. So what are underlying assets? Underlying assets are nothing but the shares which you trade in, bonds, then commodities which some of you might be trading in, then currencies, then market index, that is your Nifty 50, Bank Nifty. All of this are nothing but the underlying assets. So derivatives are nothing but that will derive its value from these assets. That is, it may be stock, it may be commodity, it might be bonds. So if I have to give an example relating it to stock market, say derivative stock. Okay, derivative stock is a asset, underlying asset. Now, what is the derivative of this Reliance stock? The derivative of this Reliance stock is nothing but the options, the futures. Yes. So to make it simple, Reliance stock is underlying asset and Reliance derivatives, okay, is a derivative. That is, maybe Reliance options, maybe Reliance futures, all these are derivatives. So the moment the value of the Reliance stock increases, the Reliance derivative will also increase. If the stock, Reliance stock value decreases, then the value of the derivative will also decrease. Hope this is clear. So derivative is nothing but a financial instrument which will derive its value from the underlying asset. Underlying asset can be a stock, can be a bond, can be commodity, can be currency, or can be any other market index. Now, what are the types of derivatives? One is futures, another one is options, then we have forwards and swaps. There are 4 types of derivatives. Now options and futures are available for trading. This is which is available in the stock market for you to trade, whereas forwards and swaps are not available for trading. So our focus in this session is on one derivative, that is options. Okay. Now let's see what are options. Let's come to the main point, that is, what are options? Options are financial derivatives that give buyers the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. Okay, let's split this definition into small parts and understand what exactly is it. Okay, these are the financial derivatives, as I already explained, that gives buyers the right. It is not the sellers. The buyers will get the right, that is the buyers of these options will get the right either to buy that particular asset on the particular day or to simply leave that contract to expire. Okay, so here this whole options, the concept of option is to give the buyers the right to execute the contract or to leave the contract to expire. Okay, so there is no obligation here. Now if I buy a option, I am not bound to actually buy that asset on the particular day. Okay, I just have the right to buy that asset on the date on which we enter the contract. Say today I will buy the option, telling that I will buy that asset maybe 1 week after today's date, then I will have the right to buy that option after that 1 week, but again I am not obliged, that is I need not necessarily buy that. If I want I can buy, if I don't want I'll just leave it to expire. Okay, now when practically we see with the example, you will get a clear idea about this. Now here buyer have a right and seller have an obligation. So when buyer have a right, it is obviously understood that seller will have the obligation. That is, if buyer says I will buy it, then seller has to give those shares, that is give those assets. And if buyer say I will not buy it, then seller cannot force buyer to actually buy that particular shares. So it is completely left to the buyer whether to buy that shares or not. Now in order to give that right to the buyer to buy that asset or to leave it, he has to buy the options. Now what is that amount that he'll pay to option, buy that option? That is called premium. Okay, here he is not, in case of stock if we take, he is not going to pay the entire value of the stock to the seller. What he will do is only to take that right, he will pay a very small amount which is called as premium, which we will learn going forward. Now let's take an example and understand it better. Okay, this is a practical example. For time being, let's keep the stock or stock market options everything aside, and let's generally see, taking an example of a house. Okay, say A is a buyer of the house, B is a seller of the house. So right now B is possessing the house and A wants to buy that house. The current price of that house is 80 lakhs. Okay, today, current price today, if I value that house, the worth of that house is 80 lakhs. Now A will listen to some rumor or some news is there in that particular place which says that some say metro or something comes in that particular area. So what happens immediately when a good infrastructure happens in that particular city, the value of the property, the value of the house, the value of the apartments, everything increase, right? Now A, after listening to all these rumors and after analyzing all the news that has come up, is of the opinion that the value of that house will definitely go above 1 crore after 6 months if that metro line comes there. Okay, so he just want to make sure that if that doesn't happen, if the news that has come does not happen, then he don't want to buy that house and fall in the trap. So he want to buy that house only if that metro line comes there and the value of that house will go beyond 1 crore. Okay, so in order to make that or reserve that house to him, what he does is he pays 10 lakhs, okay, to the seller, holding right to buy the house after 6 months for 1 crore. He know that the value of the house will go above 1 crore. So he want to reserve that house for him. Right now the value, current price of that house is 80 lakhs. So he will pay a small amount, that is 10 lakhs, to get that right to buy that shares, buy that house. He is not buying that house now, but he is entering into a contract with the seller to buy that house after 6 months for 1 crore. For getting that right, he is paying 10 lakh rupees. Now what can happen? First consequence, A will buy the house at 1 crore with total cost of 1.10 crore. When can this happen? if the value of the house goes above 1 crore, say if the value of that house at the end of the expiry of the contract, that is 6 months, goes to around say 1.3 crores. Now A will definitely buy the house, because the value of that particular house is now come to 1.3 crores. Yes, he has entered into a contract to buy that house for 1 crore. In addition to that, he has paid 10 lakhs. Now 10 lakhs is not included in that 1 crore. 10 lakhs, the down payment or the payment initially which is made is just to reserve the right. So the total cost of A is 1.10 crore. The value of that house after 6 months is coming to 1.3 crore. So 20 lakhs profit he'll make there. That's why he will execute the contract. Now if the value of that house doesn't go above 1 crore, then the contract will expire, because A has a right to either purchase that house or to leave the contract to expire. Now what is the best option that A have if the house doesn't cost? Say there was something else happening and the value of that house has come to 60 lakhs from 80 lakhs. Okay, it has been undervalued. Then the contract expires without execution with the limited loss of 10 lakhs to A. Now what is the loss that can happen to A? It is just 10 lakhs, which is again a known loss. Fine. So this is how actually the whole concept of option works. It just gives the right to the buyer either to execute the contract or not, depending upon his advantage. Now in order to get that right, he will pay some money, and that money, to that extent his loss is limited. Okay, whatever money he has paid, that he will have to lose if he doesn't execute that contract. But he can avoid a further loss that can happen if his prediction goes wrong. This is entirely the concept of options. Now let's see what are the types of options that are available. One is call options, one is put options. Okay, in detail we'll go in the next part. Now who are the parties to this options? Option contract rather. So as usual, it is an option buyer and an option seller. Now option seller also called as option writer. Okay, I will explain it in detail one by one. So first let's see call options. Again, in call options you have two terms, that is buyer of call option and writer of call option or seller of call options. Let's see how does it work. Now buying call options is also called as long call. Okay, if one says I am long on call, that means he is a buyer. He is looking for buying opportunity. Now when can you be a buyer of call option? When you expect the stock or index to move upwards. If you expect the market to be bullish, then you will go for buying call option. Now what is the advantage of buying call option? The thing is, you need not pay the entire value of the stock and buy it immediately. You can just buy the right to purchase that stock on the future date. For that buying the right, you will have to pay a very small amount. Again, that is called premium, which is again have a separate calculation process, and I will not go deep into the calculations, but I will say how is it done in a simple way. So let's look at a small example and understand it better. See, the current price is 1000. Let's take the current price of a stock is 1000. Current price is also called, if you look in the portal, there is a term called spot price or underlying price. This is nothing but the price at which the stock or index is right now or currently traded. So the premium that is required to be paid in order to purchase the call is 10. Okay. Now the underlying asset in this particular case is stock, right? Now the expected price is greater than 1200. I am expecting that the value of the stock will go above 1200. So this 1200, which is my expectation, is my strike price. Okay, I predict that the price of the stock will go beyond 1200. So 1200 will be my strike price. Now when you see the option chart or option chain, you will get different strike prices. That is nothing but the price which you expect can be met. So in this example, 1200 is my strike price, 1000 is the current price or the spot price at which the stock is traded, premium is 10. Now the time period is 1 month. Okay, usually the expiry day for that stock will be 1 month. For Nifty and for Bank Nifty, that is for all the indexes you will have weekly expiry also, along with monthly expiry. Weekly expiry is also there for indices, whereas for stock it is always monthly expiry. Now when is the expiry day? It will be on last Thursday of every month. Total cost of this particular contract is how much? 1200 strike price plus 10, that is 1210 will be the total cost of this entire contract. Now if the price goes beyond 1200, say if the price goes up to 1300, then what is the profit that a buyer will make? 1300 minus 1210, that is 90, because 1200 is a strike price and 10 rupees premium you will pay to get the right to buy that shares. So the total cost will be 1210. So the profit that we make by executing this contract is 1300 minus 1210. So 90 rupees is a profit made by the buyer by executing this contract. Now executing this contract or leaving it to expire is up to the buyer. Obviously if the price goes to 1300, the buyer will execute the contract because he will make 90 rupees profit. Now in case the stock comes down to 1000, what will the buyer do? He will not execute the contract, he will leave the contract to expire. So what is the maximum loss that the buyer will have to take? Just 10 rupees, right? Now in case if he execute the contract when the stock price comes down to 1000, then he will make much loss because he has already paid 1210 and the price is just 1000. So 1210 minus 1000 is his loss. Which is better, taking loss of 210 rupees or 10 rupees? Obviously 10 rupees is better. So the option buyer will not execute the contract, he will leave it to expire and the total loss that he will take is just 10 rupees. Now if the stock moves to 1300, he will make a profit of 90, and if the stock don't move as per his expectation, he will make a loss of 10 rupees, which is pretty decent, right? So the benefit of buying the call option is that your loss is limited whereas your profit is unlimited. That is, the stock can go up to anything, right? Now 1200 is a strike price. If the stock price goes beyond 1200, how much ever it moves, that much profit you will make. So it is unlimited profits and limited loss concept. So buying of call is advantageous if, as per your prediction, the stock moves upwards, that is if it shows a bullish trend. Expiry is on last Thursday of every month, right? Now if that last Thursday is a holiday, then the expiry will be immediate previous working day, that is Wednesday. Okay, so now you have 3 expiry options available to trade, that is current month, mid month and far month. What is this? So I'll show it in the portal also in some time. Okay, say if you take call option at strike price 1300, say, then you will have 1300 call is said as CE. Okay, in the portal they will put it as CE. CE refers to call, PE refers to put. So in the portal if you say 1300 CE, then you will have 3 options there. That is one of the current month, that is if I take now it is March. You will also have April and May. So you will have 3 expiry options available to trade. You can either go for buying of this month option, which is called current month, or mid month, that is April option, or far month, that is May options. So 3 months options will be available. Premium changes as expiry changes. Now you will get 3 months expiry options for every strike price, but the premium will also change on this different expiries. For current month expiry, premium will be different. For mid month expiry, premium will be different. For far month expiry, premium will be again different. Though the strike price is same, the premium will be different. Okay, so the next thing is settlement of option contracts. Now say I entered into a call option. Okay, I bought the call option. Now how is this settled? Let's take the same previous example. The buyer will execute the contract, okay, because the stock moved to 1300. Now actually seller will have to pay just 100 rupees to the buyer. Okay, so the amount that the seller have to pay is 1300, that is up to which the stock has moved, minus the contract price 1200, that is this 100 rupees the seller have to pay. This is called settlement in cash. This is a process followed in India. The option settlement happens in cash, that is the profit amount whichever the buyer is eligible to take, that much amount the seller has to give. It is not that seller is transferring the stock to buyer, okay? It is just the profit that the seller transferred to buyer. Now what is all about? What is the logic behind this? See, executing the contract means what? The buyer will execute the contract, he will purchase the shares or the stock from the seller, and will he hold it? Will it give him anything if he hold it? No, right? On that day, that is on the day of execution of the contract, if the value of that particular stock is 1300, yes, whereas he entered into a contract for 1200, right? So he will buy at 1200, and when the stock price is 1300 that particular day, he immediately sells it, right? There is no point in holding it, because who knows, tomorrow again the stock price may come below 1200. So what he will do, the moment he execute the contract, he will immediately sell it, right? So this entire process is made easy, and instead of he buying, taking those, literally taking those stock and again selling it, what the seller will have to do, he will have to just pay buyer the difference between the execution price and the current or the spot price of that stock. So in this case, 1300 minus 1200, that is 100 will be the amount that the seller will pay to the buyer. Now what is the real profit of the buyer? 100 minus 10, because 10 premium he has already paid to the seller. So the buyer will make the profit only after that premium is adjusted. So 100 minus 10, 90 rupees will be the profit of the buyer. Hope this is clear. Settlement in cash means the stock is not actually moved from one person to another. Instead, only the value of profit will keep on moving. Now let's come to the important term, that is premium. So I was telling that in order to get the right to purchase the shares, a small amount is paid by the buyer to the seller, which is called as premium. So premium is paid by the option buyer to obtain the right to exercise the option contract, right? So this small amount which is paid is again calculated keeping in mind different factors. This premium that we pay is not same or is not constant. It will not be same for the whole day. Minute by minute this premium changes. Why? Because premium is affected by different factors. So the main parts of this premium is the intrinsic value and time value. So intrinsic value plus time value will be the premium. Now what is time value? It is again a separate calculation. It's mainly based on Greeks. What is Greeks? I will explain in a while. Now let's see how to calculate the intrinsic value. Intrinsic value for call option and the calculation process of the intrinsic value for put options are different, slightly different. The formula for calculating intrinsic value of call option is spot price minus strike price. Okay, for call options, intrinsic value is spot price minus strike price. That is, spot price on expiry is say 1500 and strike price is say 1300, then your intrinsic value is 1500 minus 1300, that is 200 is the intrinsic value, right? This is for call options. Call options is where we expect the price to go above the strike price, right? We expect the spot price to go above the strike price, so our spot price will be more than the strike price. So the intrinsic value is the spot price minus strike price, which is in this example 200. Now if the spot price on expiry is below the strike price, that is if it is 1000, we expect the price to go above 1300, but the stock didn't move as per our prediction and the spot price on expiry came below the strike price, that is 1000. Now what is the intrinsic value? Is it 1000 minus 1300 is equal to minus 300? No, the intrinsic value will be 0. Okay, So intrinsic value should always be positive. You cannot consider a negative figure as intrinsic value. If you get spot price minus strike price as negative, then you have to take it as 0, which means there is no intrinsic value in that particular contract. And if the spot price minus strike price is positive, that means there is an intrinsic value in that particular premium. Okay, the moment intrinsic value comes negative, that means intrinsic value is 0 in that particular premium. Intrinsic value is 0, and whatever premium is remained, that is just the time value. Now, when will the call option becomes profitable? If the spot price moves over and above the strike price, then the call option will give you profits, because you are predicting that the value will go above certain price, which is called the strike price. So when the spot price is greater than the strike price, you will make profits out of call options. And when loss can happen in case of call options, if you are a buyer, loss can happen when the spot price moves below the strike price. That is, if your prediction goes wrong and stock moves below the strike price, that is the price at which you entered the contract, then you will end up making losses. Hope this is clear. Now, you should also know the term break-even point. Okay, now all these that I am explaining, intrinsic value, break-even point, everything is with respect to call options. Okay, for put options it will be slightly different. I will tell it moving forward. So now for call options, break-even price is a strike price plus premium. So break-even point is a point or the price at which you will make no profit, no loss. Okay, your profit is equal to loss is equal to 0. Okay, you will have no profits or you will have no losses. This is the break-even point. So how will you calculate the break-even point? Strike price plus your premium will be the break-even point. So once the spot price crosses this break-even price, then the call option buyer will start making profits. Okay, so if you take the example of this 1300, strike price is 1300, premium is 10, right? So altogether, what is the cost? 1300 plus 10. The cost incurred by him is 1300 plus 10. So only when the stock moves above 1310, then only he will make profits. So if the stock moves up to 1310 and expires, that means he will not make any profit, any loss when the stock is at 1310. The moment it crosses 1310, the call option buyer will start making profits. So this is a break-even point. Now let's check this concept of call using the portal, trading portal. I'll use Zerodha portal here for reference. So you can see here, Infi, I have taken example of Infosys. Infi spot is at 1374, right? Now if I open the chart of Infi, day chart, you can see that on March 1st, it was at around 1263. It opened at 1263, and today it is at 1373. That is around 100 points it has increased, right? Now if I want to buy a call, if I take Infi 1400 call, here you can observe 3 options will appear: one of March, one of April and one of May. As I already told, this is current month, this is mid month and this is far month. So 3 options will be available for you. Now if I take Infi March 1400 CE, then if I take the chart of this, you can see that in March beginning it was at 9.7, the premium was at 9.7, and now today the premium is at 19, right? So because of 100 points move in the Infosys stock spot price, premium of the call moved from 9 to 19, that is 10-point increase. Now if you see for expiry another hardly 15 days remaining, right? So if the stock moves quickly or shows a very good rally and it crosses this 1400, then it is fine. Now if you buy, you will be in profits. If the Nifty moves very quickly, that is does a very good rally. Otherwise, if it is in the same range, that is around 1374, or if it comes down, then you will end up in loss. Why? Because there will be decay in this premium. In this 19 rupees, now 19 rupees will not be 19 throughout. Now if the stock rallies, then of course the premium will increase, so you will end up making profits. But if the stock doesn't rally, if it comes down, or even if it stays in the same position, that is nearly same position, then your premium will start decreasing when you go closer to the expiry, because of the important factor, that is time decay. As I told, premium is made of two components, intrinsic value and time decay. Now if the stock doesn't quickly cross this 1400, due to time decay, your premium will start decreasing. Now what is time decay? It is based upon Greeks, okay, another important concept. I'll explain it going forward, but for now you just understand, when you buy the call, yes, if you are bullish in your approach, you will go for buying the call. But when you buy the call, while selecting the strike price, you have to be very careful. You have to select a strike price which you feel will definitely cross, okay, as per your analysis and prediction. If you select some strike price which is far away, telling that your risk is less, and if you just keep waiting, say March 1st itself you buy, okay, of that expiry, March expiry, and you say there are 4 weeks left, so anyways I'll make profit because stock will move there. If that is your prediction, definitely the chances of going wrong is more, because the expiry is very far, right? You have 4 weeks around for expiry. If you take a strike price of a far distance, then chances of stock crossing that strike price is less. So though the premium, you will get some premium when you buy, because of this decay your premium goes down. Even though the stock reaches that somewhere near to that strike price, because of time decay itself you will make loss. So time decay is not favorable to the buyer. So when you buy, when you select the strike price, you have to be very careful. Now time decay I will explain very clearly, because which is again a very important concept. So before that, let's see what is put. Now buying put options. Now as I already told, in options we have two types, calls and puts. Calls, buying of calls, I have already explained. Now let's see buying put options. What does it mean? What is put? What is buying of put? How is it advantageous? And what are the things to be kept in mind? First, put in the sense you are expecting the stock or index to move in the downward direction. In call, you are expecting the stock or index to move in the upward direction, whereas in put you are expecting the stock or index to move in the downward direction. Here, the buyer of the put option, please pay attention, this is very important and it's a little bit complicated also. The buyer of the put option buys the right to sell a stock at a price irrespective of the spot price of the underlying asset. So here also the buyer is taking the right to execute the contract, but here the contract is what? Selling the shares. In case of call options, you were buying the call option with taking the right to buy the shares in future, but in this case you are buying the put option with the intent of selling the shares or stocks in future to another person who will be again the seller or the put writer. So the difference between call and put, you have to be very careful. In call option, you are expecting the stock to move upwards and you are entering into a contract or buying the call option in order to buy it in future, buy the stock in future. And in put, you are expecting the market or the stock to come down and you are buying the put option, which will give you the right to sell the shares in future to a particular person. So put option writer upon expiry will have to buy if the put option buyer is selling him. That is, the whole right is with the put option buyer. So put option buyer will have the right to either execute the contract or to leave it to expire. Again, expiry and all these things are similar to the call options. Now, the intrinsic value calculation is slightly different than the call options. In put options, intrinsic value is equal to strike price minus spot price. Under call options, intrinsic value was spot minus strike. Here it is strike price minus spot price. Why? Because you are expecting the spot price to be lower than the strike price. Because you are expecting the stock to move downwards. So obviously the spot price should be lower than the strike price in order to get the intrinsic value. Again, as I told, intrinsic value should always be positive. Intrinsic value is negative means intrinsic value is nothing but 0. So there cannot be a negative intrinsic value. Only when the intrinsic value is positive, you consider premium is made of that intrinsic value plus time decay. If intrinsic value comes to negative, that means there is no intrinsic value with respect to that premium. So whatever value premium it is showing, it is all of time value. So buyers of this put options are profitable as and when the spot price goes below the strike price. So here you will strike a price, you will tell that the stock will move below the strike price which you select. So you will expect the stock to move below the strike price which you will predict or you will select. So when the stock moves below the strike price which you selected, you will end up making profits. Similarly, a put option buyer experiences a loss when the spot price goes higher than the strike price. When the stock doesn't fall, obviously the purchaser of the put option will make losses. But the loss is limited to what extent? To the extent of the premium paid by him. Next, let's check break-even point for put options. Okay, here this is quite opposite to the break-even point for call options. Here you have to calculate the break-even price by deducting the premium from strike price. That is, strike price minus premium will give you break-even price of the put options. In call options, it was strike price plus premium, and here it is strike price minus premium. Why? Because under put options, you are expecting the market to come down. That is, you are expecting the stock or the index to move below the strike price. So, strike price minus premium will give you a price wherein you will not make any profit or loss. So, once the stock falls below this break-even price, you will start making profits. So, for example, if we take strike price of 1300 and premium of 10, then the break-even price is 1300 minus 10, that is 1290. So if the stock falls below 1290, then you will start making profits. So now let's quickly see this put options in the Kite portal. As I told, we'll take the same example of Infosys. The spot is 1374.85. So let's take a put. Infi March put. If you take 1300 put, then here you can see again March, April, May. You will have 3 options available of 3 months, that is current month, mid month and far month. So you can select any one of this. Now if we take of March, if we see, then the premium comes to 5.6. Now if we check this chart, beginning in the March when it opened, the opening was 58. You can check here, it was 58 and now it has come to 5.6 in 15 days. You can see from 58, from that is in the first March, it has fallen to 5.6, right? This is because put option is where you expect the market, the stock will come down, right? In this case, what has happened? Infosys stock moved in the upward direction. So the value of put decreased. Okay, you expected the stock to come down, but the stock moved in the upward direction. That's why there is a drastic fall in the premium of put. That is from 53 it moved to 5. So if you have a stop loss set, then obviously you can exit early. Now if you hold it, see the loss that you make. 53 minus 5 into the quantity that you have taken. So this is how it works. Premium keeps on varying. When it comes near to expiry, the premium comes down. Again, if the stock moves in the opposite direction, then the premium will fall. Also, I would like to show you over here the quantity that you can trade. Always options you can trade in lots. So here the moment you click buy, you can see the quantity is coming to 600. So Infosys stock you can trade in 600 quantities. You cannot trade in 1 quantity or 2 quantity like stocks. Similarly, this quantity will vary depending upon the stock. That's why when you keep the stop loss, you have to see what is the value of the what is the quantity that is traded and then fix the stop loss. So here 1 point means into 600. That will be your stop loss. So when the value of the stock is less, the quantity traded will be more. Per lot the quantity will be more. So you have to see the quantity and then decide your stop loss. This risk management is very important when you trade. Next, let's come to another important segment, which is writing. Okay, what is writing? Writing is nothing but selling. First let's take up call option writing. You also call it as short call. Okay, so here the risk involved is unlimited. Again, risk unlimited in the sense, if you fix the stop loss, then you can convert your unlimited risk to limited risk. For an option writer, the profit is just the premium that he collects, be it a call or a put. For the option writer, the profit that will be available to him is just the premium which he collects. So he already knows what is a profit that can happen, and the loss that can happen is again unlimited, but you can fix it by putting the stop loss. So once you already know how much profit you make, there is no question of greed over here. So emotionally the writer will be strong, but the capital that he requires is huge. So if he have a good capital, then actually in the market the option writers are the smarter ones. Okay, most of the time it is the option writers who will take the maximum money from the market, because they invest more, they know exactly what is their return, so their mind will be set for that, and to minimize the loss anyways they'll put stop loss. So they will be the one who will be taking a lot of funds from the market. Now they are the smart players and major players. Why? Because the winning percentage is more here, because when you buy an option, the chances of you making profit is only when the market moves as per your prediction, right? But in this case, when you write options, you collect the premium, and you have two cases wherein you can make money. One is when the market moves as per your expectation. The second is, even though the market becomes range bound, still you will end up making profits. Why? This is where the time decay plays a major role. So time decay is favorable to the seller and is unfavorable to the buyer. Now for the seller, even though the market or the stock or index, whatever he has sold, does not move according to his prediction, it has become range bound, even then he will make money because of decay in the premium. Because of the decay due to time value, he will collect the premium and he will leave it to expire and make some money. On expiry, obviously the premium will decrease, so there itself he'll collect the amount that is due to this premium decay and make some money. So here again, when the stock crosses the break-even price, as usual, option writers will start losing money. That is in respect to call options, strike price plus premium will give you the break-even price. So once that price is crossed, then option writer, that is call option writer, will start making loss. Now, profit of the call option writer is limited to the extent of premium received as long as the spot price remains at or below the strike price. So whatever profits he makes is limited to the premium that he collected. The call option writer starts to lose money as and when the spot price moves over and above the strike price. Only in this case he will lose money, but what he will lose is again unlimited loss until he fixes the stop loss. Next, similarly, put option writing. Here also the view of the put option writer is bullish. Okay, the view of the call option buyer is bullish, the view of the put option writer is bullish. Similarly, the view of the put option buyer is bearish and the view of the call option writer is bearish. Okay, now if both are the same cases, why are we going to do that? If put option writer is also having a bullish approach, then why don't we just buy the call option? This can be your question. Now, if the premium is low, then you can go for buying of call option because you will get that option at a lower price. And if the premium is high, then which is favorable? Writing the put option is favorable because you will collect more premium. So you have to see which is favorable. Even if your view is bullish, okay, if the premium is more, buying the call option will not give you much good result, but writing of put will give you more result because you are collecting more premium over there. Similarly, if your approach or your view is bearish, then instead of writing the call, you can go for buying the put. Again, whether you will buy the put or you will write the call, depends upon the premium value. So sellers of the put options are profitable as long as the spot price remains at or higher than the strike price. That is, if it is range bound or if it is higher than the strike price. And unlimited loss can happen when the spot price goes lower than the strike price with respect to put option writing. Now the important thing which you have to know before trading is the concept of different strike prices that are available, that is in the money, at the money and out of the money. Now when can you say that an option is in the money? If intrinsic value is not equal to 0, that is if you get the intrinsic value, that means that particular option is in the money. If the strike price is very near to the spot price, that is when you round off, if the spot price comes near the particular strike price, then it is said to be at the money. Similarly, if the intrinsic value is equal to 0 or even if it comes negative, you will consider it to be 0, then that option is at out of the money. Okay, now clearly I will explain this with the help of option chain. So this is NSE website. Here you can find the option chain of all the stocks. Now I have taken Infosys for reference. So here you can see the underlying index, that is a spot price is 1375.3. So whichever strike price is near to this price will be the at the money strike price. So 1375 is currently the spot price. The price which is near to it, that is 1380. 1380 strike price is at the money. Here left side is a call side and right side is a put side. So these are the strike prices. Here you can see different strike prices are available and 1380 is nearest to the spot price. So this strike price is considered to be at the money. So this dark area which you can see, that is 1360, 1340, 1320, all these are actually in the money because stock has already crossed all these prices and has moved up. Similarly, the prices which are not yet reached by the stock, that is 1400, 420, all these, that is white area, these are all out of the money. That is yet the stock has not moved till here. So if we select a stock which falls under this area, then we say the strike price that we selected is in the money, and if we select any of these strike prices, then we say we have taken option which is out of the money. Now as we move far away from this, we say it is deep in the money with respect to this side, and with respect to this side we say it is deep out of the money. So the price which is near to the spot price is at the money, the price which is already covered by the stock is called in the money, and as long as we move away from it, it is deep in the money. Similarly, the strike prices which are not yet crossed by this spot price is out of the money strike prices, and as we again move far away, it becomes deep out of the money. Similarly, for put, 1380 is a at the money put, and here since we in put means we expect the stock to move down, so 1360, 1340, all these become out of the money, and 1400, 1420, that is this darker shade area, this will become in the money. Here again similarly deep out of the money and deep in the money. And in this option chain you will also get to know the volume that is traded, and you will also get to know the bid price and ask price. Bid price is a price that purchasers are willing to pay. Ask price is a price which sellers are offering for different strike prices. You will also get that in this option chain. Next important concept is option Greeks. Now the premium is affected by different factors. It is not only the intrinsic value, it is also affected by 5 different factors which are called as Greeks. So the factors that affect the premium to change minute by minute is option Greeks. So premium is equal to intrinsic value plus time value, I said. So time value is also affected by Greeks. So what is this Greeks? We have 5 things in this, that is delta, gamma, vega, theta and rho. Premium is affected by all of these factors. Now let's look into each of these factors to understand what it is actually. First is delta. Delta is nothing but change in the premium due to 1 unit change in the underlying asset. That means underlying asset is nothing but the stock. If the stock value increases by 1 point, what will be the increase in the premium? This is given by delta. Say if delta is 0.5, that means if there is 2 units or 2 points increase in the stock, there will be 1 point increase in the premium of that stock. Similarly, if delta is 0.25, then if there is 4 points increase in the stock, then there will be just 1 point increase in the premium. So this is how the increase in the premium or decrease in the premium is calculated based on this delta. So it measures the sensitivity, that is how sensitive is the premium of a particular stock with respect to that stock. Say for example, at 10 am if Nifty spot is 1200 and the premium is 35, now at say 10:05 the Nifty spot is 1201, then what will be the premium? To calculate the premium, we have to see what is a delta change. If you get to know what is a delta change for 1 unit change in the stock, then you will know what is a change in the premium. So change in the premium is equal to delta into points change in the underlying asset. Now these delta values and all, you need not bother much how it is calculated and all that. So usually put delta will be from -1 to 0, okay, because in the put side you will be expecting that the market will fall, so the delta value, that is a change, will be between -1 to 0, and in the call side the change will be from 0 to 1. Here another thing is, always at the money delta will be 0.5, that is if it is in the put side then it is minus 0.5, if it is call side then it is plus 0.5. So if the delta value with respect to put is around -1 to -0.5, that means it is in the money. When the strike price is at -0.5 with respect to put, that means that strike price is at the money, and once it crosses -0.5, from -0.5 to 0, if it falls, that means that strike price is out of the money. Similarly, in call side, always at the money strike price will have 0.5 delta, nearing to 0.5. So if the strike price is between 0 to 0.5, that means it is out of the money, and if the strike price is from 0.5 to 1 anywhere, that means that strike price is in the money. Next, let's move to the second factor, that is gamma. What is this gamma? It is change in delta for 1 point move in the underlying asset. Delta is change in the premium for 1 unit change in the underlying asset, whereas gamma is change in the delta for 1 unit change in the underlying asset. So the gamma will be at its highest when options are at the money, and it will be in the lowest when the options are out of the money. You need not bother much about gamma, because while trading you don't have to, the main thing required is delta. You should just know the concept of gamma, that's enough. So on expiry, gamma will be at its highest because the change in delta will be more. The next important concept is theta. Theta refers to time decay. That is, when you go close to the expiry dates, the premium will start decreasing, that is decaying. That is because the time gap. For example, if we buy some food product, okay, the expiry dates will be written in that food product, right? So if the expiry date is far, that is if we have still many days left, then there will be a good value to the product. We go and buy that product. Now when we see that product, if we see that the expiry date is already over, or today is expiry day, that is when we buy, then what happens? The value of that product diminishes, or the value of the product is 0, then we don't consume that product. Similarly, as and when we move closer to the expiry day, the premium of that particular option will decrease because the value becomes less or diminishes. That is what is given by this measure, that is theta. The time decay is measured using theta, that is the rate of decline in the value of the option over time is called theta. Closer the expiry, more will be the time decay, and this time decay is advantage to the seller or the writer. Say you collect 80 points, just because of this time decay, the value, the 80 rupees will come down. So that difference between 80 rupees and the reduced premium itself is a profit for the seller. So time decay or theta is advantage to the seller. Option writer collects premium and waits for the time decay. And my expiry trading strategy, which I will be giving along with this video, that is exactly based on this time decay, wherein I collect the points, collect the premium and wait for the time decay. The next component in this Greeks is Vega. What is this Vega all about? It measures the sensitivity of the implied volatility. So what is this implied volatility? it represents the market participants, that is beta buyer or seller, his expectation on the volatility, how volatile is the market. So IV plays an important role when you buy the particular stock. Now even when you beat an index or stock, you have to check what is the IV of that particular stock. If the IV is very less, that means that stock is going to be range bound, because there is no much volatility, people are not expecting anything, so the chances of that stock being range bound is more. So if you go for buying the call option, say, you will end up either at loss or with not much profit, because that stock will be range bound. But if the IV is more, that means people are reacting more and the chances of that stock moving is more. So if you feel that the stock will move in the upward direction, you have to check the IV. If the IV is good or is more, that means the chances of that stock showing a greater movement is more. So farther the expiry, more will be the vega, because initially there will be a lot of volatility. Once you go near the expiry, this volatility becomes decreasing. So volatility is a measure of risk, as I already told. Larger the stock range, higher is the risk. That is, the farther you are to the expiry, the risk will be more. So there is another concept of India VIX, okay. It is again an official implied volatility index. This measures the overall volatility of the market. So while applying the trade, any strategy, it is also important to check the India VIX, because many of the strategy are based on this. You have to first check the VIX. If VIX is more, then few strategies will not work. If the VIX is less, then few strategies will give good results. So India VIX is again another official implied volatility index which you have to check while applying some of the strategies. So if India VIX is low, that means there is no fear in the market participants, so the market will go up. If India VIX is high, that means there is lot of unclear things in the market, that is there is lot of fear in the market, people don't know what will happen, so people don't want to take the risk, so they will start selling their positions. That's why the market will come down. So India VIX will play a major role. Depending upon your strategy, you have to check the India VIX and then only apply the strategy. Now whenever you apply the strategy, it's always important to consider all these factors: India VIX and the type of the stock selection, the selection of the strike price. Without this, whatever strategy you apply, it will not work. If you apply on the wrong stock, or if you apply the strategy on the wrong strike prices, then no strategy will work. Selecting the proper strike price, or if it comes to stock, selecting the proper stock is also very important for any strategy to work. Next, it is rho. Again, I will not go too deep into this. Rho is a measure of option sensitivity to interest rate changes. Okay, if you want to hold options for the long term, then this will come into picture, wherein the change in the interest will also matter, because instead of investing somewhere else where you will get the interest, you are investing in options. So when you hold for the long term, this interest rate change will also impact the value. So cost of carrying the position over time is called rho. Another last term which I want to explain over here is open interest. What is this open interest? In option chain, if you check, there is a separate column which says open interest, and this is very important actually. Many of them doesn't look at it. This is very important before you buy or sell. Say for example, A sells 3 options to B. Okay, that means 3 options are now open. Yes, 3 contracts are there now, so open interest is 3. Now A sells another 5 options to C. Now another 5 is added, contract, yes, so 3 plus 5, 8 becomes your total interest, open interest. Now A squares off first position by buying 3 options from D. Now A already sold 3 options. Now he have to buy it from somewhere, yes, because he has already sold. He just borrowed and sold. Now he have to buy it. B, to whom that options were sold, he should also square off that position by selling those 3 options to E. So A squares off first position by buying 3 options from D, and B squares off the first position by selling 3 options to E. So now what happens? The first contract, this contract, with respect to 3 options is closed. So the total open interest will come to 8 minus 3, 5. So this is how open interest is calculated. Now when you check in the option chain, you have to see how much is the open interest. So if the call side open interest, whichever is high, that will act as a resistance. That is, there are a lot of open contracts with respect to call side. It will act as a resistance, that is, stock might move till that level and again reverse back. Similarly in put side, this open interest whichever is high will act as a support, because the stock might move till there and there you have a lot of open interest, open contract where the stock can take a U-turn. So open interest will act as a resistance and support. So you have to also consider this open interest while calculating what is the resistance and support levels. Let's check this open interest in the option chain. This is option chain of Nifty. So the current price is 15,030, that is a spot price of Nifty is 15,030. So here if you see, in this side, call side, you can see open interest is more at around 15,200, that is 37,974. Okay, that is with respect to 15,200. So this 15,200 you can expect to be the resistance level, because in the call side where there is open interest, more open interest, that means it will act as it can act as a resistance, because here there are buyers and sellers sitting. So the chance of this particular strike price 15,200 acting as a resistance is more. Similarly, if you check in the put side, 28,046 here open interest, which is the highest at 15,000. So if the stock falls, then if Nifty falls, then at 15,000 it might take support and again take a U-turn. Similarly, if you see here, with respect to this strike price 15,100, which is near to the present price, here the open interest is 16,235, that is a lot of writing is happening here, whereas in the put side 2,835 less, which means here writers are more, that is they are expecting the Nifty to move in the downward direction. That's why here call writing is happening. So this is how we have to check the open interest. Now intraday traders will keep on checking this, okay, before taking the trade. Similarly, you have to also check the change in interest over here, change in open interest. Now this keeps on changing. Here you can see 13,676 put writers are coming in, which means they are expecting the market to go up. That's why they are writing the put over here. So this change in open interest and open interest you have to closely monitor before taking the trade. Whatever strategy you apply, you should also keep a close watch about this open interest. Again, you can see IV over here. So whenever you go for buying, you have to check this IV also. IV with respect to that particular strike price which you want to buy, you have to check the IV. If IV is above 25, that means there will be very good movement in the premium. If IV is below 25, you may not get that good movement in the premium. So always check the IV before you take the trade. So you have to check the open interest, you have to check the IV, and whatever be the strategy, these two things you have to check and then only select the strike price. I have tried to cover the basic things which are important. So this will help you while applying any of the strategies. Knowing these basic concepts, if you apply the particular strategy, you will be able to make good out of it. Hope this video was helpful. I strongly recommend you to trade in stocks first, at least for 1 year, to obtain the experience, because managing the risk is very important while trading. However, best strategy you use, if you don't have required knowledge in stock, then you cannot sustain in the market. If you directly go for trading in options, it becomes really difficult. I can assure you that in around 3 to 4 months your capital will be wiped off and you will be disappointed and you will exit from the stock market. So it is always better to learn and then earn. So first do paper trading and then only start trading, actually put your money. So I wish all of you success in trading, and yeah, happy trading.